Hey guys, TommyBryson here, and as you guys know, index funds are becoming more and more popular. And the general idea is basically index funds are very safe, good investments, close your eyes, put money in, don't worry about it, right? But in reality, could we see an index fund crash in the future where basically it can crash the market and collapse everything? And that's what we're going to talk today about in this video. So if everyone invested money into index funds, could that cause a problem? On top of that, currently, not everyone does that. But could we see a problem in the future when it comes to index funds and also ETFs that follow index funds? Okay, that is the core idea for this video. And by the way, I learned one thing when it comes to investing. There are zero investments out there. You can basically close your eyes and never look at them again. Usually, there's zero out there. You always need to understand what you're investing into, how everything works, and on top of that, check back to it to see exactly if the story you made about that company or that index fund or that ETF is still holding up to actually be true. Now, if you guys are new here, I post videos every single day, so you should also subscribe and hit the bell to get notified, on top of also destroying the like button. Now, the very first thing is this, guys. My definition of a bubble is basically when the hype and the demand gets so high to the point where price no longer matters. For example, I invest into this company, this stock, and all of the value says, hey, this stock right here is worth $100. Guess what? There's so much demand and so much hype that drives the price all the way up to 1,000 or 2,000. That's what we saw basically during the tech bubble, when you had so many companies being valued so high because of all the demand, to the point where the actual value did not matter. The actual business did not matter. And that's when you have a bubble actually being created. However, when it comes to index funds, they're based on NAV. Now, NAV is based on the net asset value. That's how you get the price, and they spit at the price only once a day. However, when it comes to ETFs, the track various indexes out there, they're also based on demand that's actually happening. So tell me, how can this actually go ahead and cause a bubble? How could it get to the point where basically there's so much money in indexes, or for example into ETFs and just things that basically just track indexes out there, to the point where you can actually go ahead and cause a bubble? Well, here are the facts, guys, okay? And these facts are based on two statements made by very smart people. For example, Charlie Munger, Warren Buffett's right-handed man, and also Michael Burry, one of the guys who predicted the entire 2000 crash when it came to the housing market. Now, the first statement that I want to break down when it comes to this crash is basically, according to Charlie Munger, if everyone invested into index funds, it wouldn't work. Now, here is my interpretation of this, okay, guys? Now, right now, currently, index funds only hold around 20% of all the money invested in the stock market, while 80% of the rest of the money is held by people trying to go ahead and beat the market. Now, here's what happens if everyone were to go ahead and invest into the index fund market, and that is it, okay? So index funds held basically 100% of all the money invested into the stock market. Well, what would happen is this, in my theory. The idea is you would have a bunch of money being pumped into companies that might not really deserve all that money. Now, the price of those companies is going to be based not on the value of them, but in actuality by the money that's being put into the indexes. Now, that might go ahead and cause a bubble because basically, again, you have a bunch of demand, but where you actually don't have value that actually deserves that. So I have, for example, a crappy company, but it's in that index and it gets a lot of money, but it doesn't really deserve it. And that can cause a meltdown. Now, here's something that you guys also need to know. The way the stock market works today is very important. It works that way because basically, when you have so much demand and supply happening, and companies being picked by people, in actuality, it helps the overall market of the American nation. Because, for example, when you have someone betting on a company and hope for it to go up, that's the entire idea, right? You have a company actually being built up, a lot of capital injected into it, and hopefully it becomes successful. But when you only have indexes, you have a lot of companies that are, for example, well-known, that basically are there, they get a lot of money, although they might no longer be actual good companies. And in reality, that might go ahead and cause a meltdown. And that's my theory, that if everyone were to invest just into index funds, it wouldn't be a good idea overall for the way the stock market is supposed to be functioning. And by the way, also, according to an economist, he says basically, when we get to the point where index funds have 90% of all the money in the stock market, that's when we're going to have a massive problem. But again, we're only at 20% right now. And again, I also doubt we'll actually get to that point very, very soon because in reality, people and human nature have a nature to always go ahead and try to beat the market, not just, for example, just follow it the way most people actually do. Although, for example, following the market has shown that basing results into more money being earned than going out there and giving your money to a mutual fund or a hedge fund to try to beat the market. But in reality, they're not actually doing any of it. They're actually losing a ton of money compared to the market average. So that's how potentially you could have a market crash. Now on top of that, here's a second point by Michael Burry. Now, the general idea is this, right? Right now we have a combination where people invest into index funds, also into mutual funds, actively held ones, also ETFs, also by picking stocks, and you just have people basically doing everything they actually want to do. Now, what could happen here? In reality, if you have a mass panic, like we had, for example, back in March, and people started selling all their ETFs and also a bunch of index funds, well, a bunch of money gets taken out from businesses that before actually had that money. And now you can have a massive collapse because basically people started taking the money out from their index funds, from their ETFs, also from their mutual funds, and so on and so on, especially a lot of trading going on in the stock market. Now, this means that by having so many people pull money out from ETFs and also mutual funds and index funds, in reality, that could also cause a massive collapse. But I also believe that only holding 20% of the entire market index funds is very unlikely that that's going to cause a massive collapse, although theoretically it could in the future. And by the way, I saw that also happen back in March. For example, a lot of people that were investing into ETFs and also index funds said, for example, hey, the market is crashing, I'm losing money here. They pulled out a lot of money and it crashed by around 20 to 30%. I went ahead and I rebought some ETFs for a lesser price, meaning I got to buy them at a massive discount. Now, overall, guys, the lesson of this video is basically, yes, you could have a bubble form in index funds. Yes, there is no bulletproof way to go ahead and invest, okay? Nothing is secure. So that's why basically you want to make sure what you're doing is something you understand and also makes sense for you and what you actually want for the future. So although right now currently I'm a primary investor into index funds, 80% of all my money is into index funds, the idea is I make sure I do 3 things in order to make sure in the future I will be okay. The first thing is I do dollar cost average when it comes to investing, meaning I invest the same amount of money every single week. That way I buy high and low and I'm not worried about buying way too high and it crashes and now I have a problem. So this way I do dollar cost average. I invest the same amount of money every single week, or for you, you can do it every single month. On top of that, when it comes to my index funds, I'm not just invested, for example, in the US stock market, but on top of that, I'm invested into small cap companies, into large cap companies, like basically like big companies, guys, and on top of that, into the international market, into corporate bonds, into treasury bonds, into real estate, and on top of that, into emerging markets. This way, I have a very well diversified portfolio. This way, if at one point the US market crashes, I'll still be good if the international market is good and bonds are still doing great, okay? That's the core idea. You want to be diversified. Just because an index fund holds a lot of companies does not mean you're ultimately diversified, because basically you want to be diversified across many sectors. That way you're more protected. And lastly, guys, here, you want to remember that what you're doing and the game you're playing is a long-term game. So when I'm investing to the stock market, I'm not thinking about today. I'm thinking about 20 to 30 years in the future. And I strongly believe in 20 to 30 years, America will be bigger. Companies will be bigger. The market will be better. But I don't know how it's going to do tomorrow or the next day or the next year or in 2 years or 5 years. I don't know. I can't tell you that. But in actuality, I can guarantee you one thing. Eventually, the market will crash again. There will be a massive correction. And the only thing I'm going to do then is go ahead and buy more investments, because basically, I will have cash on hand. And on top of that, I would make it a rule to invest 20% of all my income into the stock market, okay? That, or into an investment that makes you money. 20% to make more money, to make your money grow, whether that's into the stock market, into real estate, whatever it is. But you want to be diversified. That's the core idea. Even when it comes to index funds, which are so diversified, you also want to be diversified across index funds also. That is the idea. So in the future, we could have a bubble, but at this point, only at 20% ownership of the stock market, is very unlikely. That's the idea of this video. Hopefully it made sense, guys. If it did, comment down below, let me know any questions. And on top of that, if you're new here, subscribe me to the bell so you're notified. If you guys want to text me, talk to me one-on-one, join my Patreon, link down below, or send me a DM on Instagram at TommyBryson. And before I go, if you want to watch a full video on how I go ahead and invest money, the answer is here's a video right here. And on top of that, it shows you exactly what index funds I invest my money into. And also, I'll see you tomorrow. Thanks for watching, and as always, peace. Don't close your eyes. Keep them open.